silver could open, gap up, or gap down. And here's the part. Nobody's talking about both outcomes are dangerous. Most traders are praying for direction. But right now, direction doesn't matter. Volatility does. A gap up could look bullish and still wipe out late buyers. A gap down could look bearish and still explode higher after trapping sellers. This is one of those rare moments in the silver market where being early is just as risky as being wrong. If you don't understand what's coming at the open, this market can punish you in minutes. Right now, the silver market is sitting at a pressure point. Price is compressed, positioning is extreme, and liquidity around the open is thin. That combination creates a dangerous setup because when silver opens with a gap, it doesn't just move price. It triggers forced reactions, forced buying, forced selling, margin calls, stop loss cascades. Many traders believe a gap up is bullish and a gap down is bearish. In a market like this, that belief can be financially fatal. A gap up can trap emotional buyers right at resistance. A gap down can shake out weak hands before a violent upside reversal. And right now, silver is vulnerable to both traps. In this video, we are going to break down why silver gaps are especially dangerous at this stage, what a gap up really means behind the scenes, why a gap down can actually become more explosive later, and how smart money watches the market after the gap, not during the panic. This is not about predicting direction. This is about surviving volatility, because in the current silver market, the open is not an opportunity. It is a test. If you want, I can now tighten this further for a YouTube voiceover asterisk, convert it into a cinematic intro with pauses. Silver is not moving randomly right now. What you're seeing on the chart, the tight ranges, the hesitation, the back and forth is not weakness. It's compression. And in markets, compression always comes before expansion. Over the last sessions, silver has been trading in a narrow band while volume quietly builds underneath. That tells us something important. Buyers and sellers are both active, but neither side has full control. This is dangerous territory because silver is a thin market compared to gold. It doesn't take much capital to push it, especially during low liquidity periods like market opens or overnight sessions. Now, add leverage to that picture. The silver futures market is heavily leveraged. That means a relatively small price move can force liquidations, margin calls, and algorithmic reactions. When price is compressed and leverage is high, the market becomes unstable, not because of fundamentals, but because of positioning. Another factor most people ignore is timing. Gaps don't happen during high liquidity. They happen when the market is transitioning from Asia to Europe or from overnight trade into the US Open. That's when spreads widen, orders thin out, and algorithms have more influence than human decisions. In simple terms, silver becomes easier to push and harder to control. This is why silver gaps are more violent than gold gaps. Gold absorbs shocks. Silver amplifies them. And right now, silver is sitting just beneath key psychological and technical zones. That means any sudden move up or down can trigger automatic reactions, not thoughtful ones. Stop loss orders fire. Options decay accelerates. Futures traders are forced to act, not choose. This is why the upcoming open matters so much. Not because of where silver opens, but because of how many traders are trapped on the wrong side when it does. And once that pressure is released, the market doesn't move politely. It moves fast. Let's talk about the scenario everyone is hoping for. Silver opens gap up. Headlines turn bullish. Social media explodes. And suddenly, fear turns into at first glance, a gap up feels like confirmation, like the market has finally chosen a direction. But in reality, gap ups in silver are often the most dangerous moves of all. Here's why. When silver gaps higher, it usually happens during thin liquidity. That means price didn't rise because massive buyers stepped in. It rose because there weren't enough sellers in that moment. This creates a false sense of strength. Retail traders rush in, afraid of missing the move. Late buyers hit market orders. Options traders pile into calls. But while emotion is chasing price higher, smart money is watching behavior, not direction. Institutions and banks understand something. Most traders then see a gap up at a key level as an opportunity to distribute, not accumulate. They sell into strength. They let retail absorb the risk. And this is where the trap forms price may hold for a few minutes, maybe even an hour, just long enough to build confidence. Then volume shifts. Buy orders slow, sell orders increase, and the market starts to fade. This is how bull traps work. Not with a sudden crash, but with false stability. Traders who bought the gap now realize there's no follow-through. Stops are placed tightly below the open. Once those stops are triggered, the move accelerates downward. What looked like a breakout turns into a liquidity grab. And psychologically, this does more damage than a straight sell, because traders don't just lose money, they lose confidence. They chase again. They hesitate later. They misread the next real move. That's why gap up is not automatically bullish in silver. In fact, in markets like this, a gap up often marks the point where strong hands exit, asterisk, asterisk, and weak hands enter. So if silver opens higher, the real question isn't, is this bullish? It's who is buying and who is selling into them. Because in silver, strength can be the most expensive illusion of all. Now let's talk about the scenario nobody wants. Silver opens gap down, the chart looks ugly, red candles everywhere, and fear takes control before logic has a chance to step in. A gap down feels bearish because it hits traders emotionally. Losses appear instantly. Stop losses are triggered automatically. Margin pressure builds fast. Indicieverfia spreads quicker than facts. Here's the key thing most traders miss. Gap downs Dante happen because everyone suddenly agreed silver is worth less. They happen because liquidity disappears. During thin trading hours, large sell orders or algorithmic pressure can push price lower without real resistance. That creates panic, not balance. Retail traders react first. They sell to protect capital. They close positions at the worst possible moment. Stops cascade, price accelerates lower, but this is where the story changes. As price drops into key zones, something different happens behind the scenes. Physical demand wakes up, commercial buyers step in, short sellers start watching their risk. Silver is unique because it is not just a financial asset, it is an industrial and physical one. When paper price collapses too fast, real-world demand increases. And that's why gap downs in silver often don't end where fear peaks. Once selling pressure exhausts itself, the market can reverse violently. Shorts rush to cover, liquidity returns, and price snaps higher, often faster than it fell. The traders who sold in panic are left watching from the sidelines. This is the cruel irony of gap downs. They feel like confirmation, right before they turn into opportunity. That doesn't mean every gap down is bullish. It means asterisk, asterisk, blind fear is just as dangerous as blind optimism. Because in silver, the market often uses fear to reset positioning, not to signal long-term weakness. So if silver gaps down, the real question isn't, is this the start of a crash? It is. Is this fear being used to transfer silver from weak hands to strong ones? And by the time that answer becomes clear, the move is usually already underway. What makes this moment in the silver market especially dangerous is not the direction of the next move, but the condition of the market itself. Silver is fragile right now. Liquidity is thin, positioning is crowded, and emotions are running high on both sides. In this kind of environment, the market does not reward being right about direction. It rewards patience and punishes reaction. When too many traders are leaning in one direction, the market naturally looks for the path that causes the most damage. A gap up hurts late buyers who mistake momentum for strength. A gap down hurts fearful sellers who confuse speed with truth. Both moves trigger forced behavior rather than thoughtful decision-making, and that is exactly what algorithms and large players exploit. Another key risk is leverage. Silver is heavily traded with borrowed money, and leverage turns small price changes into large financial stress. Whether the market gaps higher or lower, that stress forces liquidations, margin calls, and emotional exits. These reactions add fuel to volatility and disconnect price from fundamentals in the short term. This is why direction alone is misleading right now. A bullish open can still end in losses, and a bearish open can still reverse violently. The real danger is assuming the first move is the real move. In unstable markets, the opening gap is often a setup, not a signal. Right now, silver is in a phase where the market is testing discipline. It is shaking out impatience, punishing overconfidence, and rewarding those who wait for confirmation instead of chasing emotion. Until volatility settles and price behavior becomes consistent, both gap up and gap down scenarios remain equally dangerous. In markets like this, losses are not spread evenly. Certain traders are far more vulnerable, and silver has a way of targeting them with precision. The first group at risk is over-leveraged futures traders. When silver gaps, price doesn't move step by step, it jumps. That jump is often enough to trigger margin calls instantly, leaving no time to react. Positions are closed automatically, not because the trade idea was wrong, but because leverage removed flexibility. Options traders are the next group exposed to damage. Gaps destroy assumptions. A sudden move can collapse option premiums through volatility shifts or time decay, even if price later moves in the right direction. Traders who bought short-dated calls or puts expecting a clean breakout often find themselves losing money while silver moves exactly as they predicted, just not in the way their options needed. Retail traders chasing confirmation are also heavily impacted. A gap looks like clarity, especially after days of tight price action. Many traders wait for that moment, believing the market has finally revealed its hand. But by the time they act, they are often providing liquidity for smarter players exiting positions. What feels like confirmation becomes entry at the worst possible price. Stop-loss dependent traders suffer quietly but consistently. In high volatility opens, stops do not protect at the expected level. They execute where liquidity exists, not where risk was planned. This slippage turns small losses into large ones and adds frustration to financial damage. The common thread among all these groups is not a lack of intelligence. It is lack of adaptability. Silver gaps punish rigid strategies, excessive leverage, and emotional urgency. The traders who suffer most are not those with a bias, but those without a plan for volatility. While most traders fixate on where silver opens, smart money focuses on what happens next. The gap itself is just an event. The real information comes from how price behaves after the initial shock. Institutions are not interested in the first candle. They are watching the reaction. One of the first things they observe is volume. If silver gaps up or down, but volume fails to expand meaningfully, it signals a lack of real commitment. Moves without volume are easier to reverse and often exist only to trigger emotional trades. Strong volume that continues after the open, not just at the open, carries far more weight. They also pay close attention to time. The first 30 to 60 minutes reveal whether the market is accepting the new price or rejecting it. If silver holds above a gap up level without immediate selling pressure, it suggests absorption. If a gap down fails to push lower and price stabilizes, it signals exhaustion of fear rather than strength of sellers. Another critical factor is whether the gap begins to fill. Gaps that fill quickly often indicate manipulation or imbalance rather than genuine demand or supply. When price rushes back into the prior range, it tells experienced players that the opening move lacked conviction. Smart money also watches the relationship between paper price and physical behavior. If silver drops sharply on paper while physical demand strengthens or premiums rise, it exposes a disconnect. That divergence often precedes sharp reversals. Instead of asking whether silver is bullish or bearish, experienced traders ask a different question. Is the market being accepted at this level, or is it being rejected? That answer matters far more than the direction of the gap itself. In a market like this, survival comes before profit. Silver is not offering clean signals right now, and forcing trades in high volatility is one of the fastest ways to give money back. The first rule is patience. Let the market reveal its intent instead of trying to predict it. The opening move is often designed to provoke emotion, not reward analysis. Position size becomes critical. Smaller positions reduce emotional pressure and allow flexibility when price behaves unexpectedly. In volatile conditions, being underexposed is safer than being perfectly positioned. Survival gives you the ability to act later when conditions improve. It is also important to stop thinking in exact prices and start thinking in zones. Silver rarely respects precise levels during unstable periods. It reacts around areas of interest, then overshoots, then corrects. Traders who demand precision tend to get shaken out, while those who allow room for volatility stay in control. Discipline matters more than conviction. Being bullish or bearish is less important than being prepared for both outcomes. If a trade idea depends on everything going smoothly, it is not suited for this environment. Plans must include failure scenarios before success scenarios. Above all, accept that missing a move is not a loss. In fact, In markets like this, not trading is often the most profitable decision. Silver will always offer another opportunity. Capital loss to impatience is far harder to recover than a trade that was never taken. Right now, the silver market is not asking whether you are bullish or bearish. It is asking whether you are disciplined or emotional. A gap up can reward patience and punish excitement. A gap down can expose fear and reward those who stay calm. In this environment, the market does not move to confirm opinions. It moves to test behavior. The most important takeaway is simple. The gap itself is not the signal. What matters is how silver behaves after the panic, after the excitement, and after the forced trades are done. That is where real direction is revealed. Until volatility settles and price action becomes honest again. Caution is not weakness, it is strategy. Waiting is not missing out. It is protecting capital. Because in markets like this, silver doesn't take money from people who are wrong. It takes money from people who rush. Stay patient, stay disciplined, and let the market show its hand before you play yours.